Trading can be a thrilling endeavor, but it's crucial to approach it with a well-defined strategy. Just like any skilled craftsman needs the right tools, a trader needs a reliable plan to navigate the markets effectively. Without a structured approach, trading can become a guessing game, leaving you vulnerable to emotional decisions and inconsistent results. A well-defined trading strategy serves as your roadmap, guiding your decisions and helping you stay focused on your goals. A robust trading strategy consists of several key elements. It should outline clear entry and exit points, helping you identify when to enter and exit trades based on market conditions. It should also include risk management rules to protect your capital from significant losses. Additionally, a sound strategy should be adaptable to different market environments, allowing you to adjust your approach as needed. Remember, trading is not about predicting the future. It's about having a system that allows you to react effectively to market movements and capitalize on opportunities. By developing a well-defined trading strategy and sticking to it consistently, you can increase your chances of success in the markets. One of the fundamental principles of technical analysis is that prices move in trends. A trend is simply the overall direction of a market or security's price movement over a period of time. Trends can be upward, bullish, downward, bearish, or sideways, ranging. Identifying the trend is crucial because trading with the trend significantly increases your probability of success. To determine the trend, traders use various tools and indicators including moving averages, trendlines, and chart patterns. Moving averages help to smooth out price fluctuations and reveal the underlying trend direction. Trendlines, drawn connecting successive highs or lows, act as support and resistance levels, confirming the trend's validity. Recognizing the trend is like understanding the current of a river. If you try to swim against a strong current, it will require much more effort, and you're less likely to make progress. Similarly, trading against the trend can be challenging and lead to losses. By identifying and trading in the direction of the prevailing trend, you can harness the market's momentum and improve your chances of profitable trades. Trendlines are a fundamental tool in technical analysis, providing valuable insights into the direction and strength of price movements. Think of trendlines as a roadmap for traders, highlighting areas of support and resistance in the market. When used correctly, trendlines can help you identify potential entry and exit points for your trades. To draw a valid uptrend line, connect at least two successive lows, valleys, on a price chart. The line should slope upwards, indicating that prices are making higher lows, a characteristic of an uptrend. Conversely, a valid downtrend line connects two or more successive highs, peaks, on a chart, sloping downwards to show lower highs, typical of a downtrend. The more times the price touches and bounces off a trend line, the stronger the trend line becomes. A break of the trend line, with significant volume, can signal a potential trend reversal or a pause in the current trend. Trendlines are not foolproof, but they provide a visual representation of the price action, helping you make more informed trading decisions. Section 4. Understanding Fibonacci retracement. Fibonacci retracement is a popular technical analysis tool based on the mathematical sequence discovered by Leonardo Fibonacci in the 13th century. This sequence, which starts with 0 and 1, is characterized by the fact that each number is the sum of the two preceding ones, 0, 1, 1, 2, 3, 5, 8, 13, 21, and so on. In trading, the Fibonacci retracement levels are used to identify potential support and resistance levels where prices might reverse or stall. The most commonly used Fibonacci retracement levels are 23.6%, 38.2%, 50%, 61.8%, and 100%. These levels are derived from mathematical relationships within the Fibonacci sequence. To apply Fibonacci retracement to a chart, traders identify a significant price swing, either high to low or low to high, and then divide the vertical distance by the Fibonacci ratios. The idea behind Fibonacci retracement is that after a significant price move, prices tend to retrace a predictable portion of the original move before continuing in the initial direction. Traders use these levels to identify potential entry points, set stop-loss orders, and anticipate potential price reversals or continuations. Section 5. Combining trends and Fibonacci for buy signals. Now let's combine the power of trendlines and Fibonacci retracement to identify high-probability buy signals. This strategy works best in an uptrending market. The idea is to look for price pullbacks that coincide with both a rising trend line and a Fibonacci retracement level. This confluence of factors increases the likelihood of a successful trade. First, identify a stock or other asset that is in a clear uptrend. Then, draw a trend line connecting the recent lows. Next, apply the Fibonacci retracement tool to the most recent significant price swing from low to high. Look for areas where a Fibonacci retracement level intersects or comes close to the rising trend line. These points represent potential buy zones. The rationale behind this strategy is that the rising trend line indicates buying pressure, while the Fibonacci retracement level suggests a potential area where the pullback might end and the uptrend could resume. By entering a long trade near these confluence zones, you are essentially buying on dips in an uptrend, increasing your profit potential and reducing your risk.